Hi, this is Kurt Kringelis, Head of Credit Strategy for Voya Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. Within the fixed income market, the high yield and emerging corporate markets were able to absorb the impact of higher treasury yields and deliver positive excess returns, while lower spread sectors suffered. Stability in oil prices and favorable technicals supported the high yield and emerging corporate markets. In contrast, the U.S. corporate market was negatively impacted by record new issue volume, which weighed on spreads. Within the U.S. investment-grade corporate market, record new issue volumes weighed on spreads across the board, leading to negative excess returns for all industries. Duration exposure was a key differentiator for industry relative performance. Longer duration industries, such as the utility and communication industries, performed poorly in response to the rise in treasury yields. Shorter duration industries and those with less supply volume, such as the financial industry, performed much better with modestly negative excess returns. The energy and basic industries performed roughly in line with the overall market and were supported somewhat by the relative stability in oil prices. In contrast to the pattern for most of last year, stability in oil prices did not translate into energy industry outperformance and positive excess returns for the overall market due to the heavy corporate new issue supply. On a year-to-date basis, stable to slightly higher oil prices have helped the energy industry build a substantial year-to-date excess return lead. The financial industry has benefited from improving credit trends, a lack of event risk, and short duration. Higher treasury yields and investor concerns about duration have contributed to weakness in the communications and utility industries. Excess return performance across the middle of the market has been modestly negative, with negative event risk and exposure to foreign earnings contributing to some of the performance differentiation among these industries. Credit spreads decoupled from oil prices on duration concerns and higher than expected corporate new issue supply. We expect duration and new issue supply concerns to dominate spread movements in the near term. Prior to May, Treasury yields had generally moved sideways, but within a fairly wide trading range. In mid-May, Treasury yields broke out to the upside. This upward movement in Treasury yields, coupled with heavy long-dated corporate new issuance volume, contributed to weak excess return performance during the month for long-dated securities. As we look forward, we see some potential for yield-focused buyers to support the market, but we see more potential for heavier than expected new issue supply to continue adding pressure to corporate spreads. In our view, spreads will probably drift sideways and perhaps a bit wider heading into July, when new issuance should ease in conjunction with the start of the second quarter earnings season.